Hello, everyone. Welcome back. My name is Mayur Thaker. I am an equity strategist here at Zacks Professional Services, and this is a big macro update as of May 2024. And this is a ongoing series that I've been doing for the past year and a half now, looking at the macro picture, both from macroeconomic side as well as aggregate S&P 500 earnings side, and then aggregate S&P 500 valuation, and to give my overall, diagnosis of where we are in the business cycle and whether there are risks to the equity market, as I have been saying for quite a while now. And I continue to believe that despite the strength in the market, risks are continuing to pile on. So this is a big update, so grab a bite to eat, grab a coffee, sit back, relax, and enjoy the show. So let's dive into what I am thinking as of the latest information. So I still believe we are working towards recession. I was wrong initially that I thought the recession would come by Q4 of last year. It never did. And, the data started to move against my thesis. And so I did revise my statement a little bit, saying that we're not in recession right now, and recession is not yet imminent. I'll tell you exactly what I'm looking for before I start to declare that it is imminent. But as of right now, I don't believe recession is imminent, but we are still working towards that ultimate end game. I believe that the end game is recession, and the current data is suggesting that we continue to move towards that eventuality. Manufacturing remains in contraction now for 18 months. We still have an inverted yield curve that's been a reliable leading indicator for a economic recession. Consumers are starting to show weakness. We'll take a look at a couple of data points there. Employment is cracking. This is very important because so far, what's been holding up the economy has been a very strong jobs market. We've seen people, jump around between jobs at a very high pace. So the quits rate was very high. That's an indication of a very strong job market and a lot of labor mobility, as well as rising wages. That's also an indication that labor has been in demand. But now these indicators are reversing, and it's moving quite rapidly in the opposite direction. We'll take a look at that. Credit continues to deteriorate. This is another very important sign that stresses are starting to show in the consumer. We'll take a look at that. And then lastly, which is the most important thing for the market, is corporate profit growth outside of big tech is still mostly explained by inflation. So we haven't really seen a lot of real earnings growth outside of big tech. We'll take a look at some of the data points there. And inflation currently is primarily remnants of housing and services. So I continue to actually be bearish on inflation. I think inflation is coming down, even though the headline number on CPI has not yet shown it. It's been kind of sticky and stubborn sideways at roughly 3%, well above the Fed's target. But I believe that eventually even that number will come down because of the weaknesses that I'm seeing elsewhere in employment, in credit, and in manufacturing, which is a leading indicator in and of itself of the business cycle. So let's take a look at that, all of these points here one by one. Here's a quick earnings recap. So we're mostly done with Q1 earnings, and Q1 earnings have been pretty good. Of the 461 companies that have reported thus far, 4.8% earnings growth year over year. 77% have beaten their expectations. Revenue growth at 4.1% year over year. That's pretty good. That's a fairly strong print, but it's at a much lesser beat rate at 59.7%. That's tracking well below recent quarters of the last year. So the percentage of companies that are beating the top line are much less compared to how it usually tracks. That number is usually well in the 60% range, but it's now below 60%. So it's kind of weaker than expected there. And also what's very bullish is that earnings growth actually improves to 9% year over year if we exclude energy, because energy has been a headwind. So if we exclude them, the earnings growth improves to 9%. But as usual, the majority of this growth is attributable to mega cap tech. If we remove mega cap tech, then earnings growth for the first quarter falls to minus 1.9%. And that's on plus 3.2% revenue growth. So revenue growth is actually still pretty good, even excluding mega cap tech. But earnings continue, and therefore margins continue to be a headwind outside of tech. Because remember, tech is not a big part of revenue growth, but it's a huge part of earnings growth, because big cap tech is where all the margins are. That's where the big margins are, from software, from services, from highly specialized equipment like NVIDIA's H100 GPUs. These are high margin products. So tech doesn't explain a lot of revenue growth, but it explains the lion's share. In fact, more than 100% of the earnings growth year over year, because that's where the margins are. And so overall, fiscal year 2024 growth is expected to be at plus 9%. That actually declines to plus 6.4% if you exclude technology. And revenue growth for the year is expected to be 1.6%. Folks, this is very, very tepid growth. Earnings are one thing, because when you have a bigger mix of high margin products from technology, you can have that boost in earnings, but revenue, 1.6%, that doesn't even cover inflation. So, I still continue to kind of throw a little bit of shade on these earnings and revenue growth numbers, because once again, the vast majority of it is coming from technology. But even if you include technology, revenue growth overall for the S&P is only expected to be up 1.6%. That's less than the rate of inflation expected for this year. So real revenue growth is going to be negative this year, folks. That's hardly something to be excited over for a market that trades at 21 times forward earnings. This is a bull market PE for growth that is barely positive. In fact, it's negative, adjusted for inflation. Here you can see on a quarterly basis the year-over-year growth rates. You can see that the analyst community is still very bullish. The green bars represent earnings growth year over year, broken down by quarter. So here we see for the overall S&P 500, earnings are expected to be up 6% this quarter in Q1. That improves to 9% in Q2, 7.3% in Q3, and then a huge jump in Q4 of 12.2% earnings growth. So this is, again, analysts continue to be very bullish on the aggregate S&P 500 index, and again, a lot of that, in fact, most of that is attributable to big tech. Here, if you look at it, excluding big tech, this is excluding the Mag 7 specifically, and the Mag 7, as you can see here, are Apple, Amazon, Meta, Google, Microsoft, NVIDIA, and Tesla. If you exclude them, the numbers come down quite a bit. You can see that minus 1.9% year over year in Q1. However, that's expected to really rebound in the later quarters. We'll see if that materializes, but so far, the evidence has really not shown as to whether the S&P can actually grow on an inflation-adjusted basis outside of big tech. Once again, in Q4 it was negative, in Q1 it was negative, but analysts continue to stick by their thesis that this is going to turn around in Q2 onwards. So we will see if that happens, but I continue to throw doubts on whether these growth rates are going to be attained this year, because we still have not seen it yet flow through in Q1. Nonetheless, analysts are getting bullish again, as you can see, with those numbers being expected to accelerate in the back half of this year. You can see that S&P aggregate earnings expectations for 2024 continue to move up. They were, on a consistent decline since, October, November December, January, February. It bottomed out in February, and now it's actually starting to rebound into today. And this is very relevant because we now have Q1 in the books, and analysts are still sticking by their forecasts that they were at not too long ago before Q1 was even reported. Back in November we were at 2,100 for aggregate earnings. This is in billions. And now we're basically back to that number now today after going below that right before Q1 was reported. So analysts are very clearly bullish on earnings, and it's for a good reason. Technology continues to be a major tailwind. With NVIDIA reporting very solid results. We'll see how they do because they have an off reporting period. So they're actually up to report in the next coming weeks. But Microsoft, Google, Amazon all reported extremely strong results. Amazon really beat on the AWS side of the business. That's where all their margins are. And again, this is the reason why technology continues to power S&P aggregate earnings expectations for the year. So again, the earnings environment is that of stable growth, primarily powered by big tech. But there is some assistance from consumer discretionary, big banks, as well as retail. Now, from a leading economic standpoint, right, the yield curve continues to be inverted. So, unless if history has changed itself, we are still on a collision course with recession. But keep in mind, earnings can accelerate even during times where the yield curve is inverted. Remember, earnings are actually at best a coincident indicator. So earnings can continue to grow even after recessions were declared. That was the case in 2008. That was the case in 1999, in the early part of 2000. So remember, companies can cut costs. Companies can make layoffs to brunt the impact of any downturn of aggregate demand. And that's what we've already started to see, big tech announcing layoffs. So initially, when you see the early parts of the recession, which are usually very soft, a soft decline in demand, companies are able to battle that out, by controlling costs. And that's why earnings, even though they are bullish right now, earnings are at best a coincident indicator of the business cycle, sometimes even a lagging indicator of the business cycle. So we can have an instance where we are at the precipice of a recession, or at least are barreling towards a recession, while earnings are still strong. So that is not something outside of the ordinary. We can still have a stable earnings growth picture while we are in the early parts of a recession. And so the yield curve has consistently been a reliable indicator for a recession, and we continue to be inverted on that. And this is now the 24th month of the inverted yield curve between the spread between the 2-year and the 10-year. So this, I believe, is going to continue to be correct, although it has been delayed. Now let's look at the jobs market. This is something I constantly look at. If you've been following me on this channel here in my past webinars, permanent job losers are one of the most reliable indicators of an oncoming jobs recession. And here you can see this number overlaid with a 3-year moving average. This is something similar to the SOM rule, if you're familiar with that, but I believe this is even more effective than the SOM rule. Every time permanent job losers has crossed over its 3-year moving average, meaning its 36-month moving average, we have been in a confirmed jobs recession where job losses have really accelerated in the coming months after that. Here we saw that in early 2000, we saw that in 2007, we saw that in 2020, and now we're seeing it today in 2024. Keep in mind, this is once again a leading indicator. It doesn't mean that recession is imminent. It just means that recession is coming. So by that we could mean, it could be coming now, or it could be coming a year from now. Because remember, back in the last time this happened, which was in 2007, this was mid-2007 when we crossed above that 3-year moving average, and it took another 6 months before the recession officially started, but we didn't even know we were in that recession until a year later. Because remember, that recession was declared in December of 2008, and permanent job losers crossed over that 3-year moving average in the summer of 2007. So, things didn't get truly bad until, Lehman collapsed in September of 2008. But we were already in a recession which was declared in arrears in December of 2008. So we could very well be in a recession right now, but we wouldn't know it until much later. But this tells you that it's time to start getting cautious here, because this is not a good trend. We do not want to see to see this happen, especially because the biggest part of the U.S. economy is retail sales, retail spending, consumer spending, and consumption. Consumption is a huge part of GDP. It's 60% of the U.S. economy, and when jobs are lost, that part of the equation comes at risk. And that is exactly what we are starting to see now. So it's time to get cautious. This doesn't mean that the market is going to crash tomorrow. It just means that it's time to get cautious because jobs are coming under pressure. Here we see another metric that's also indicating something is happening. Full-time jobs. Everybody looks at the total non-farm payrolls number, but if you look under the hood and look at how full-time jobs are doing, this assesses the quality of the jobs that are being created. We're now at 900,000 fewer full-time jobs since the peak of June 2023. And for the first time in any non-recessionary period, full-time jobs are in contraction. As you can see here, this number never really dips below zero on a year-over-year basis, except for maybe one-off, 1 month, time frames, like we saw over here, very briefly, just for 1 month, like we saw over here in the mid-90s. But now this is the third consecutive month of contraction year-over-year. We're at minus 0.4 year-over-year in April. Again, the third month of contraction. That's never happened outside of a recession. So once again, this is another indication that the job market is weakening, I should say. And you can also see from a long-term trend growth basis, over a 10-year trend growth, we are well below trend. Although now there is something for the bulls, because just in my prior update, we were down 1.8 million. Now we're down just 900,000. So we had a big rebound in this number in the April jobs report. So that was very, very encouraging. So month over month, that was a very tremendous bounce back. So we will see how the coming months go. But again, we've never been in contraction year over year. So we're still down from the peak, and we're still down year over year. So we'll see how this number trends. But again, this is not a very good trend, because we are still well below pre-pandemic trends here. We've never truly recovered where we were at trend growth. Aggregate payrolls, again, so the headline non-farm payrolls number has been very strong, 1.8% growth. That's tracking really where it always has been during bull market periods, throughout the 2010s, throughout the 2000s, throughout the 1990s. 1.8% is exceptional. It's right where things really should be. But if you look at the subcomponent of that, which is what I like to call leading cyclical employment index, this has now posted the 11th consecutive month of contraction. Remember, this is a collection of industries that are more sensitive to changes in aggregate demand than the rest. These are the industries that start to turn ahead of business cycles. As you can see here, this leading cyclical employment index enters contraction ahead of recessions, ahead of the aggregate jobs number. And sometimes that lead time can be 12 to 15 months, as you can see over here. The lead time was pretty good over here. Back in late 2006, it actually entered contraction. And it wasn't until mid-2008 when the aggregate non-farm payrolls went into contraction. That was a lead time of a year and a half. Sometimes that lead time is shorter, like it was over here at roughly 1 year. So we'll see where it ends up being this time around, but as of right now, it's been 11 consecutive months of contraction year over year. So if you're interested, this group of leading industries include the following: plastics and rubber manufacturing, rubber products manufacturing, building material and garden equipment dealers, trucking, administrative, durable goods wholesalers, residential building construction. Again, I went through basically every sub-industry group that the monthly non-farm payrolls report publishes, and I just took a look at it over time, over say multiple decades, and I picked out the ones that have a truly leading edge to that, meaning these are the industries that start to turn down and start to turn up ahead of the aggregate jobs report, out of aggregate non-farm payrolls. So the purpose of doing this is to give you a leading edge, to give you an early warning that the broader jobs, job conditions are going to deteriorate, or on the upside are going to accelerate. They have a history of turning ahead of the broader business cycle because these industries are inherently more sensitive to changes in aggregate demand. Rather than, say, for example, other more durable industries such as education, healthcare, and government. Remember, these three industries are not analytically relevant because they continuously rise no matter what's happening. So they are not sensitive to the business cycle, and therefore they don't give us any information as to where we might be in the business cycle, entering recession or exiting recession. So if you remove these non-cyclical sectors and look at just the leading cyclical industries, that gives us these industries right here. And as you can see, combined, those industries have shed jobs now for 11 consecutive months year over year, and it's at minus 0.7%. I will say that it has started to rebound a little bit, so we will see where this number goes. But as long as it remains in contraction year over year, and we're about to cycle out a full year now, once we get the May jobs report, if that becomes, once again, a contractionary number year over year, we've now had a full year of declines in leading industries in terms of jobs. That does not bode a very good picture for the overall jobs, the future of overall jobs. As an example, temp help services is one of these leading cyclical indicators. Temp help services is actually a sub-industry group of administrative. So I took the full administrative industry group, but within administrative is temporary help services. And as you can see, if you look at that, overall number on a year-over-year basis, temp help service jobs contract well in advance of recessions. As you can see here, it turned down well in advance of the 2008 recession, well in advance of the 2000 recession, even well in advance of the COVID recession, although that's probably by kind of a coincidence rather than being able to truly predict that, because COVID was a freak event that nobody could have really predicted. But you can see here that this is now turned down in 2022. But remember, sometimes this can have a 2-year leading advantage here. So if you were to take a look at how it turned out in 2008, it flipped bearish in 2006, and we really didn't know that we were in recession until 2008. So now we're pretty much approaching that 2-year mark with regards to temporary help services. So things could start to get a little murky, and that's kind of being confirmed now because permanent job losers, as I showed, is just now crossing over its 3-year moving average. So I think now is the time to start getting a little bit bearish on the health of the job market. Here you can see job openings. This is another indication, the JOLTS report. This is now at cycle lows. You can see it just hit the lowest levels during this cycle. We're still well above the pre-pandemic levels, but remember, population has grown, the labor force has grown. So this number in general always grows. So even during that recession of 2020, right, when COVID hit, we were basically still almost basically at the highs of 2007. So just because we're above the prior cycle highs does not mean that this is still a bullish number. And here I kind of showed trend growth over, say, a 10-year time period. We're now well below trend growth. So, this job openings number is supposed to rise over time. And yet we're now below trend. We're also below that 3-year moving average, the 36-month moving average. As you can see, every time we have, broken below that 36-month moving average, the job market has worsened significantly. So again, these are, multiple indications that the job market is, currently under pressure. Here you can see average weekly hours, as a result of all this, is in rapid decline. This is also consistent with recessions, as you can see here. Things are not moving in the right direction. So again, leading employment indicators together are pointing to a rapidly deteriorating job market. This could be why, and as we're going to see in the coming slides, this could be why consumers are increasingly delinquent on credit card payments and auto loans. We just got an update from the New York Fed this past week, just 2 days ago, showing that delinquencies are rising. Credit card delinquencies are at 7% and trending higher. This is the highest level since we exited the Great Financial Crisis. We're way above where we were during the bull market 2010s. Same thing goes with auto loans. They're much lower, but they are at cycle highs, the highest levels basically going back to 2010, 2011. That's not a good time period to be revisiting, folks. So something is happening with the health of the consumer, and I believe that it has to do with the deteriorating job market as well as other things as well that we're going to take a look at just in a few minutes here. But here is the transition into delinquency. The first chart I showed you was transition into serious delinquency, meaning they are 90 plus days late on making the payments. 7% of all balances are now seriously delinquent with credit cards. Almost 3% seriously delinquent on auto loans. And now if you look at it on the first step, this is obviously, just into delinquency, meaning 30 plus days. So that's not severely delinquent, but obviously you have to get to delinquent before you can get to severely delinquent. So this is the first step, the earlier indicator. And here you can see both auto loans and credit cards, again, are at cycle highs, well above where it normally is during bull markets. And currently we're now back to levels that we haven't seen since we exited the Great Financial Crisis in 2010, 2011. These are not good trends. This is not what we want to see. Here you can see a breakdown of the auto loans, seriously delinquent auto loans by age range. And as we would expect, the young kids out there thought they could, buy, nice cars, and turns out they really couldn't afford them. But you can see that, Gen Z is defaulting at the highest rate, followed by millennials here. But interestingly enough, all ages, even boomers and seniors, are increasing on their default rates by auto loans. So everybody across the board is up. The seniors are not yet at where they were in, the last major recession that we had, but the trend is up and it's not good. Same thing with credit cards. Everybody across the board, as we would expect, the younger crowd is more delinquent than the older crowd, but everybody is increasing on their delinquency on credit cards, just like they are for their auto loans. So on the aggregate, if you combine all of them, this is not the trend that we want to be seeing. This tells you this is a direct reflection on the health of the consumer, and the rate of change is not good. And then if you look at it from the banking side, Discover and Capital One as two examples of companies as lending institutions, they are increasing net charge-offs as a percentage of total loans at the highest rates that we have seen since the Great Financial Crisis. Again, this is Discover Financial, net charge-offs as a percentage of total loans at 5%. We haven't seen this happen in 12 years, 13 years. Same thing with Capital One. Capital One is a lot more, Capital One is a lot more, what should we say, responsible with their lending practices, but even with their high quality loan book, the charge-off rate is at the highest levels we have seen since we exited the Great Financial Crisis, 2011. Again, these are not good trends. With the jobs report, I should have mentioned also, this slide is out of place here, but we are seeing a large gap between the household and establishment surveys. And this again suggests that the job market is much weaker than it appears. Part of this could be because a lot of people are working 2 or more jobs, and so they get double counted in the establishment survey. So if you look at the household survey, that's a lot weaker. And it really never gets this weak outside of recessions. We will see how this does, but we do have some times where it dips that low. But if the household survey enters contraction, I think that's the last shoe that we need to see in terms of confirmation that the job market is heading south. But I believe that given the leading indicators of jobs, as we already saw, the household survey will be entering contraction at some point this year. So if this happens, I believe that analysts are going to be revising down those bullish earnings forecasts quite rapidly. Here you can see that zoomed in here, the difference between the establishment and the household survey. So again, a lot of people are working double time. So this is why, although there is strong job creation on the headline number, the household number is reporting something quite different. And it's because a lot of people are working a second job, which happens most likely as part-time. Here we can see excess savings. Excess savings are now barreling down cycle lows. Here you can see a trend growth chart of personal saving. Here was that rapid jump in personal savings as a result of pandemic era policies. We had, rent moratoriums. We had, we had a whole lot of other things happen. We had, costs drop, we had spending drop, and therefore, we had huge jump in excess savings. So excess savings is just defined as savings in excess of trend growth, right, as we see here. But now, ever since 2021, personal savings has now basically been entirely exhausted. And now we're well below trend here. And here we can see an update on that exactly from the San Francisco Fed. As of March of this year, the entire amount that was built up, that $2.1 trillion of excess pandemic era savings that we built up, has been exhausted. So this entire rate of change right here has been a result of spending outpacing incomes. That's the only way excess savings comes down. Right? That's the only way personal savings comes down, is if people spend more than they earn. So the tremendous earnings growth that we have seen over the past 3 years, really since August of 2021, can be attributable to spending down all of these trillions in excess savings. But excess savings, spending attributable to excess savings, is not sustainable, because ultimately spending has to come in line with incomes. And so now that excess savings has basically been depleted, I believe that spending is going to catch down to the rate of personal incomes. And if jobs are under pressure, then personal incomes are going to decline even further, which will put significant pressure on spending. So again, I believe that given the fact that excess savings has been basically entirely exhausted, and given the fact that joblessness is rising, I believe that there will be a significant downshift in retail sales. This will begin impacting retail sales, especially in the back half of this year, and that has kind of started happening. If we look at real retail sales adjusted for inflation, we've basically been teetering at zero now for the better part of 3 years. If you look at cumulative real retail sales, it's been negative 1.5% cumulatively over the past 3 years. Now, this could just be mean reversion, because if you look at the aggregate number, the real retail sales in billions of dollars, we are just now returning back to trend. So this hasn't yet gotten bearish yet. This is kind of food for the bulls. This is the bull case right here, that we're just, even though real retail sales have been kind of tepid, basically zero for 3 years, that's just mean reversion based on that big jump in the post-pandemic time period when we were reopening the economy. Now let's look at manufacturing. Manufacturing is super important because manufacturing is one of the cyclical leading indicators of the economic business cycle. And ISM manufacturing PMI continues to contract. It's been in contraction now for 17 out of the last 18 months. That is including the latest update for April. But analysts are still expecting a lasting turnaround, because you can see that this is now forming a rounded bottom here, and it looks like it wants to set higher highs and higher lows. So that's why analysts are still bullish on earnings. Here I've overlaid ISM manufacturing PMI with S&P forward earnings growth expectations. And you can see that this shares a very strong correlation. In fact, it shares a 78% correlation historically over the past 25 years. And the reason why analysts are bullish partly is because of this potential bottoming out of the ISM manufacturing PMI. And so analysts are still bullish that this will continue to expand, and it looks like it wants to. But again, anytime this is below 50, it means that manufacturing is still in contraction. So as long as it remains below 50, this is not an expansionary manufacturing economy. Especially if you look at other manufacturing gauges like the Chicago PMI. This is a regional index that looks at the Rust Belt in the Midwest. This is depressingly negative. So this was attempting to make a recovery, but then it fell flat down to 37.9. This is pretty much the lowest levels we have seen outside of recession. So this is a recessionary print. Same thing with the New York Fed, Empire State Index. This is not a good trend. It remains below zero for the better part of the last 3 years. It really hasn't recovered much at all. So this is not a rounded bottom the way that the ISM is showing. So I believe that, if these trends continue at the regional level, ISM manufacturing is not going to be setting higher highs and higher lows. It's going to basically teeter out at roughly 48 to 49 and kind of go sideways. So if that happens, I believe the earnings expectations are going to be tapered back in. So here again is a little bit of a zoomed in effect. Here we saw that dramatic increase in the ISM manufacturing, exiting the, pandemic. And therefore we saw earnings expectations rise quite rapidly. This is why I like to look at ISM, because it has a leading effect. You can see that it started to rebound well ahead of analysts' earnings expectations. It topped out and started to move lower again ahead of earnings expectations. And here we saw analysts kind of jump ahead and start, increasing their forward-looking earnings expectations. And we see a little bit of a recovery here. We're off the lows. It does look like it wants to make higher highs, but again, this is not an absolute number. This is a mean reverting number. So what that means is, as long as it's below 50, we are still, the actual underlying gauges of manufacturing production, new orders and all the other subcomponents are still in contraction. So again, if we get another print that's below 50, we are going to see some of these earnings expectations come back in, especially when you combine it with other areas that I'm seeing concerning trends, like in jobs and in real retail sales, and in delinquencies and whatnot. I don't think that this is going to be a earnings figure that is going to materialize, because remember, analysts continue to be bullish on the back half of this year. We still haven't seen much evidence that earnings outside of big tech are really that attractive. ISM manufacturing new orders, this is a subcomponent of the PMI. Again, this remains in contraction. It's been negative for 20 of the last 23 months. The streak ended in January at 18 consecutive monthly declines, but then once again, it went back into contraction into April. We thought that this was finally making a recovery, but then it fell flat again in April. We will see where this happens, but you can see that every time it spends this much time in contraction, this has been a leading indicator of an oncoming recession. So this better rebound quick, otherwise we are going to see earnings expectations come down for the S&P 500 outside of big tech, and ultimately in big tech too, because big tech cannot operate in a vacuum. Ultimately, if retail sales get hit, that will work its way towards big tech. Factories continue to slash workweek hours. Again, back to recession levels. We got a big bounce back in the latest reading, but the trend is very clearly down. Yield curve continues to be inverted, but remember, the key about this is that it's not about the inversion, but it's the post-inversion re-steepening. When it spends a good amount of time inverted, that's kind of the early warning sign. But then when it finally re-steepens above zero, that's when recession starts to become imminent, meaning within a 12-month time frame. We haven't yet seen that yet. So this is the thing that I'm watching very closely. I'll give you that final recipe of what to look for, but this re-steepening hasn't happened yet. And that's the reason why I believe that we're not yet in an imminent recession, even though we are seeing warning signs of recession coming. It's not yet within that sort of 6 to 12 month window that markets like to look at before it starts to price in, a downturn. And history has shown that forced inversion breaks things. This is looking at the spread of the Fed funds rate versus the 2-year yield. The Fed funds rate is way above the 2-year yield. This is a forced inversion. So the Fed, I think, really should cut, but they won't because they haven't seen enough evidence yet of inflation coming down. I believe that inflation will come down because of all the pressures that we're seeing elsewhere. But the leading economic index from the conference board, that's been in decline for 23 consecutive months. Again, that's another indication that things are not yet actually really rebounding. Outside of big tech, we haven't really seen a lot of, bullish trends in earnings, especially not that one that warrants, a bull market PE multiple. GDI continues to undermine GDP. We typically don't see this ratio fall below 1 outside of recessions. Analysts are still expecting 9 to 10% growth this year. But if these leading indicators of employment, of credit, and of personal savings, if these things continue to trend the way they are, I still think these expectations are overstated. So I think that earnings forecasts will be marked down as these delinquencies continue to rise, as defaults continue to rise, as job cuts continue to escalate. Recessions are always a slow buildup of things. But I am very closely watching that yield curve. When that goes above zero, that's going to be the time to go defensive. Meanwhile, banks, especially small banks, they continue to face a lot of difficulty. We had this NBER paper come out late last year that found that 14% of all loans total, 44% of all office loans are in negative equity. That's putting up to 300 regional banks at solvency risk. This is a risk that we really shouldn't be just tossing aside. We need to be watching this because this doesn't seem to be improving at all. Loan loss provisions continue to rise for all banks across the board. Now, bank lending has actually, this was a surprise to me, bank lending has rebounded. So this could be one of the reasons why we have seen this exceptionally strong rally in the market, because liquidity has come back up. But we still see no bottom for regional banks. So regional banks continue to be a problem child in this economy. Earnings estimates continue to be slashed. We still haven't seen a bottom yet in earnings yet for these companies. And yet the market is approaching bubble territory, given all of these risks that we have seen. If at the end of the day, the market was still reasonably valued, I'd say, well, there's really not much we need to be worried about because the market is not lofty right now. But the market valuation is approaching the bubble territory of 2000. And you won't see it if you look at traditional PEs or price to free cash flows. And the reason is because you need to look at it relative to normalized earnings. And the best way to look at normalized earnings, in my view, is to look at the CAPE yield spread. This is, from Professor Robert Shiller. He publishes this on his website, on the Yale website, Yale University. And here you can see that the CAPE yield spread, which looks at the inverse of the Shiller PE minus the 10-year real yield. Remember, PE multiples are a function of both growth and the cost of capital. So we have to look at that together. And so if you look at the PE multiple relative to the 10-year average real earnings of the S&P 500, inverse that and look at that as a spread to the 10-year real yield. That number is at the lowest levels now. In fact, this is, my apologies, I didn't update this with the latest information, but this number is now 1.2%, not 1.4. But it's now at 1.2. That takes us all the way back to the highest levels just before the 2008 great financial crisis. And before that, the highest levels since, or the lowest levels since exiting the dot-com bust in 2002. So this is, basically the most expensive market, according to CAPE yield spreads that we have seen in more than, basically since the top of 2007 and going all the way back to 2002. So this is an expensive market. It's not a cheap market right now. Now, it's not as expensive as the peak of 2000. So we could still, have a lot more room to run to the upside if we really wanted to test the bubble top of 2000. But at the same token, this is not a cheap market at all. So I would urge a lot of caution here, especially as risks start to rise, if jobs start to come under pressure as they have been. This is not a valuation that you want to take a risk on. At the same time, markets typically overshoot to the upside, so there's a lot of animal spirits right now. a lot of bullish, sentiment, fueled by AI and other advancements in technology. Also fueled by very real earnings growth by technology, and I don't want to knock that. But even after you factor in all of that, if you look at, the multiple that this market trades at relative to 10-year average earnings adjusted for inflation, okay? And look at that spread versus the 10-year real yield. We are trading at the highest valuations right now in 22 years. We really shouldn't, look past that fact. Here we can see another way of looking at this, the equity risk premium. This is looking at forward S&P 500 earnings yield minus the 10-year yield, both nominal. Here you can see that, this is a very clear picture. We are negative now, meaning the 10-year yield is above the forward earnings yield of the S&P 500. So that factors in the bullish narrative of this year. So if you look at forward earnings expectations divided by the current price of the S&P 500 index minus the 10-year yield, that is negative now if you look at it from a 3-month treasury or a 1-year treasury. It's still positive relative to the 10-year treasury, but again, at the lowest levels that we have seen since 2002, 2001. This is not a very compelling valuation, folks. But as I said, we cannot ignore the tape. The S&P wants to be bullish. I wouldn't fight that trend. So right now, it's fine to be bullish because that is where the market wants to go. Earnings estimates remain strong. Analysts expect a very strong cyclical recovery after 6 quarters of decelerating growth. We have strong evidence of disinflation across various measures. We have goods disinflation, we have new homes disinflation, we have used cars disinflation. We even have commodities disinflation with the price of oil. So because of easing inflation, we shouldn't really see too much pressure from yields. I don't think, the long-term yields are going much higher. So because of that, together we have a Goldilocks blend of conditions that's fueling this powerful market rally. This is why the bulls have been in charge thus far. But my primary conclusions based on leading economic data is that the direction of leading fundamental indicator that the margin implies negative pressure to S&P forward earnings growth. So I think analysts will mark down both this year and next year earnings forecasts. But markets are priced right now for strong earnings growth. They're priced for a bull market in earnings, given the current forward P of 21 times and also the highest CAPE yield spreads in 22 years, the lowest equity risk premiums in 20 years. So if we don't get that strong earnings growth materialize, especially in the back half of this year, then we're going to be in for a very strong and substantial bear market, because we are in for not just earnings that are getting marked down, but a repricing of the multiple. So you will have a combination of a repricing multiple on lower earnings expectations. That's a double hit to the price of the S&P 500. So I think that we are at a risky time period right now. However, the market wants to be bullish, so I wouldn't fight that trend. So my plan of action is watch these 3 indicators right here. Permanent job losers, the yield curve between the 10-year and the 2-year, and the S&P 500 or the QQQ versus their 200-day moving average. If we see all 3 of these things happen, permanent job losers rise above its 36-month moving average, that has happened. That's already happened, as we saw. But then if we see these 2 happen, the 10-year yield crosses below the 10-year yield, right? That tells you that the yield curve is now re-steepening. That happens right as recession becomes imminent, meaning within a 6 to 12 month time frame. and the S&P 500 and or the NASDAQ 100 falls below its 200-day exponential moving average, if we see all three of these things happen, then it's time to go full-blown defensive. The first one triggered in February and continues to hold true through April, but the next two haven't. So as of right now, I would continue to be long the S&P 500, but keep a very close watch on these two other indicators. If these two, happen, if these two shoes drop, I believe it's time to go full-blown, defensive. And the way to be defensive is to be fully allocated in the 1 to 3 year Treasury ETF. That's the SHY ETF. These are short-term, bond treasuries, ETF. Money market mutual funds. You can also have some investment grade short-term corporate bonds, such as the JP Morgan Ultra Short Income ETF. That's the ticker JPST. And then also in an equity portfolio that focuses on the Zacks Earning Certain portfolio. Remember, this is the quality portfolio that I personally manage. These are recession-resistant equities, but focus especially on the ones that have the lowest beta, that have dividend growth and or share buybacks, and a low Shiller PE. That's also very important. So basically overall position for a low growth environment with a combination of these recession-resistant equities as well as income, between short-term treasuries, money market mutual funds, and investment-grade corporate bond. So hopefully you found this helpful. Here are a couple of the companies that we own in the Zacks Earning Certain portfolio. High-quality, recession-resistant businesses. Love to own them. This is how they look like over time, even through recessions. They have an ability to grow. That's exactly where you should be allocated. So I hope you found this helpful. Again, love to hear from you. I'd love to hear feedback from you. Critical feedback, always welcome. Please reach out to us. Give us a call at 1-866-794-6065 or send us an email to strategycall@zackspro.com. All right, thanks everyone, and hope you found this helpful again. Talk to you soon.